Good afternoon, guys. It's Ben here. I hope everyone has been kicking some serious butt in the markets. There's been some big moves in 2024 already, especially in large cap tech, as we all know, semiconductors, and pretty much anything that's network oriented or AI. But it's not only big cap tech that's been doing well. And I'm going to have a look at the top 10 stocks on the S&P 100 for year-to-date performance. Just have a look at the movers. And by the way, this data is from last week when I wrote this up. So the market got a bit slapped, right, by the CPI print earlier this week. It didn't even come in that hot, honestly. It just came in, it was like one tick higher than expectations. We'll talk more about that in a minute. But I had a pretty decent rebound today, so it's not that big of a deal. So let's have a look at what's going on here. Microsoft up nearly 10% year to date. Apple has been the problem. Apple is down a few percent. Amazon is up 11%. Google up a tad. Nvidia up almost 40% year to date and holding strong even with the overall market pullback we've seen this week. Meta 30%, guys. And that, but then we also have Berkshire Hathaway, who's doing well. Eli Lilly up over 20%. Tesla has been the dog, really, down pretty much 30% year to date. And the payment processing companies like Visa and MasterCard trading up today again. It's been doing really well. So clearly, there's been plenty of opportunities to make money if you know where to look. I'm going to dissect some of the earnings reports for few of these companies. I'm going to have a little bit of a peek under the hood. But first, what has been going on with the macro data? So macro is a huge deal, guys. Okay, we have to pay attention to macro. And remember the whole recession narrative from last year, all these so-called experts calling for a market crash because we were potentially we were by definition, in their eyes, in a recession. But it never happened, right? So in the meantime, pretty much all the major indices have pushed into new all-time highs, and a lot of the sector ETFs. In fact, today, the XLI industrial ETF pushed into new highs again. So, so a lot of these guys are still waiting for a recession, a market sell-off, and every time there's a little speed bump, it's like, okay, here it is, market sell-off. Look, we are in a bull market, and unless there's some black swan event coming around the corner, there's no reason why all of a sudden the market should just crash. And the data doesn't lie. Okay, so let's have a look at the macro data releases for the past few months. So this is the non-farm payroll. Came in pretty hot. Okay, so first week of January, came in at 216,000. Consensus was 170,000. So that's a fat number. And the February number, by the way, was 353,000 versus 180,000 consensus. So huge pickup there. And so the labor market is tightening. Now, last year, if this happened, the market would have sold off because it's kind of inflationary, right? But because the whole economy started to pick up steam, we actually have seen the market have a huge rally after this data came out. Retail sales, obviously, is not a big deal. Similar picture here. December figure was up 0.3%, and the consensus was actually negative 0.1%. And in January, it doubled. Okay, it was up 0.6%, again ahead of the estimate. So more strength than expected. Another kind of notch in the economic book, if you will, of things improving, right? So we also had the almighty US GDP quarterly growth rate came in at 3.3%. So that was for Q4, and the estimate was 2%. So even though it was behind the Q3 number, which was 4.9%, it's quite a bit of a bump up from expectations. And something else that we look at closely here is PMI surveys. There's a lot of surveys out there, okay, but the PMI is kind of the big dog. And both the ISM manufacturing and services PMI has been coming in stronger than expectations for January. And something else I follow very closely is the S&P Composite PMI, okay, which kind of breaks everything down into one index, if you will. And that thing has just been cranking higher here since last October, as you can see on this graph. So I'm presenting some of the most important and kind of biggest numbers that we pay attention to. Obviously, there's a lot of other stuff going on, but I'm not going to talk about. This is not really about breaking down the whole economy. I just wanted to kind of confirm with you guys that yes, the economy has seriously been picking up steam. And with the latest CPI print, yes, surely it came in a bit strong, but it's still hovering around 3%. So now the GDP growth and inflation is both hovering around 3%. So all in all, we have a stronger macro picture, stable inflation, which is a good thing. And that usually feeds into the bottom line of companies, so they can make more money. Now, what does all this data mean for the stock market and earnings going forward? Well, if you've been paying attention, it really shouldn't have been a big surprise, okay, that the Fed is walking back the rate cuts that they were supposed to do in March. Clearly, that's not happening. Might even be, after summer, maybe even after the election, who knows? And then the question is, okay, is that bad for the market? Well, we have seen strength in the dollar lately, and the sell-off in 10-year notes on the back of the stronger CPI print. But overall, if you have GDP growth, so the economy is expanding, doing well, and inflation is stable around 3%, which, by the way, 3% inflation has been the average over the past 100 years. So it's not really a problem. It's really more of a concern if the inflation figure is combined with weak economic growth, like we're seeing in Europe. So in Europe, the economic growth, GDP growth, pretty much zero, and they still have some inflation over there. So that's a bit of a problem. That's kind of stagflationary. But even so, the European stock market has actually done pretty well if you look at the IFA ETF. So we need to know what to look for. It's pretty clear that we're in a bull market, but it's not necessarily a market where rising tide lifts all boats. This has been kind of a selective run. This is what we call a stock pickers market. So let's look at some of these earnings for some of these big companies. Now, biggest one that comes to mind is probably Meta. About 2 weeks ago, they had an earnings report and came out, and it was a steaming ahead. Stock gapped up 20%. Okay, so yes, mega cap stocks can clearly move in a big way. Well, so then people are like, well, okay, it's overvalued. They're going to short it, which is ridiculous. They beat revenue by almost $1 billion. And yes, a lot of it has to do with the forward-looking view of anything AI related, which who knows how long that's going to last. But that is definitely what's happening, at least for now. And if you look at their balance sheet, their cash and short-term investments was ridiculously strong. Okay, so back in a year ago, so December of 2022, it was about 40 billion, which is still really high. Well, now it came out at 65 billion. That's just nuts. So as a result, we have seen massive upgrades to the EPS revisions going forward, as you can see here. And look, with strong fundamental backing, an expanding economy, and a stock price that's just ripping higher into new all-time highs, why would this stock just fall all of a sudden? Amazon has also come out with earnings, done quite well, beat revenue by 3.7 billion. Operating income jumped from 23 billion to 37 billion. So that's a 60% move, guys. So it's really no wonder that the stock has been doing pretty well. Their cash position, by the way, has doubled in 3 years. They're now at $73 billion. It's actually quite surprising to me that this stock is still below all-time highs, which is 188. But I think that's going to get hit here pretty soon. Now, it hasn't all been rosy in mega cap tech land, okay, with Tesla coming up short in both EPS and revenue. Well, a lot of reasons for this, but I'm not going to get into that here. But the stock has been smacked down by about 30% on the year. And not really surprisingly, this has resulted in huge downside revisions, okay, in EPS. And these brilliant analysts, they're just as far behind as well as a lot of the well-intentioned but potentially uneducated retail investors or retail traders. Okay, they're all just following the stock price, right? So, but we need to understand how stocks are likely to move, obviously, before they have big moves. That's kind of the whole point. And we are long, short traders focusing on options. So it really doesn't matter to us so much if something goes up or down. It's not really about that, okay? But we need it to move. So what we try to do and what we focus on and teach is identifying stocks that have a high chance of having huge imminent moves, because that's how you can make big bucks, either up or down. And when you're able to identify that, then obviously you have a good chance of making some serious money. So most major companies have now reported earnings. And overall, they've been good, right? But we still have one big gun coming, okay? It's NVIDIA. NVIDIA reports later in February. Stock is up 40% year to date. And you're kind of like, well, is that too much? That's always what people think, right? Like, has it gone too far? Well, look at it this way. The consensus estimate is for revenue to climb to $20 billion from $18 billion last quarter, and earnings to get to $4.50 versus $4 last quarter. Like, we're not asking for the world here, okay? It's actually fairly conservative estimates. Now, that said, the stock is pretty much priced for perfection at this point. So not only do they need to beat, but they need to beat by quite a big margin for this stock to continue higher, which there's a good chance that they might. So keep an eye on that. So there's been huge moves in this market already. If you're not making money when the market and the individual stocks are moving like this, clearly you're doing something wrong. So over and out. Catch you next time. It's been a trip.